Have you ever wondered how the stock market works and why it's so significant in the world of finance? Well, the stock market is essentially a grand marketplace where shares of publicly traded companies are bought and sold. It plays a pivotal role in the global economy, influencing financial trends and shaping economic growth. Stock exchanges, such as the New York Stock Exchange or the London Stock Exchange, act as the primary hubs where these transactions take place. So, in a nutshell, the stock market is a marketplace where buyers and sellers trade shares of publicly traded companies. How do stocks compare to other investment options like bonds and real estate? Well, stocks are unique. They offer the potential for substantial returns, especially in the long run. However, they are also subject to market volatility, which can mean higher risk. Bonds, on the other hand, are generally more stable but offer lower returns. Real estate can provide steady income through rental and potential appreciation, but requires significant upfront capital and management. While stocks can offer substantial returns, they also carry higher risk compared to bonds and real estate. But what exactly does it mean to own a stock? Well, when you purchase a stock, you're essentially buying a small piece of a company. You're becoming a shareholder. That's right, you have a stake in the company's assets and earnings. Now, how are stock prices determined? It's a dance of supply and demand. When more people want to buy a stock, the price goes up. If more people want to sell, the price goes down. The stock market is a vast auction house with buyers and sellers negotiating prices based on their perception of a company's value and future prospects. You've probably heard of the S&P 500 or Dow Jones. These are stock market indices, basically benchmarks that track the performance of a group of stocks. They give a snapshot of the overall market health and direction. So remember, when you buy a stock, you're buying a piece of a company and its future earnings. Let's not get lost in jargon. Here are a few key terms you need to know. First up, dividends. These are portions of a company's earnings that are paid out to shareholders. Think of it as your share of the company's profits. Not all companies issue dividends, but those that do provide a steady income stream above and beyond any potential price appreciation. Next, we have market capitalization or market cap. This is the total market value of a company's outstanding shares of stock. It's calculated by multiplying the company's share price by its total number of outstanding shares. This gives us a good idea of a company's size and worth. Lastly, let's discuss the PE ratio, or price to earnings ratio. This is a valuation ratio defined as market value per share divided by earnings per share. It helps investors determine the relative value of a company's shares in an apples-to-apples comparison. Understanding these terms can help you navigate the stock market more efficiently. Did you know there are different types of stocks? Let's delve into the two primary types: common and preferred stocks. Common stocks give shareholders voting rights in a company and the potential for dividends. But if a company goes belly up, they're last in line to receive any remaining assets. Preferred stocks, on the other hand, don't offer voting rights, but they do provide a higher claim on earnings and assets. This means preferred shareholders receive dividends before common shareholders. Each type of stock offers different benefits and risks, so choose wisely based on your investment goals. Ready to make a move? Here's how you can buy stocks. First, you'll need to open a brokerage account. This is like your gateway to the stock market. You can choose to go with a traditional broker or an online platform, which often has lower fees and is more beginner-friendly. Once your account is set up, you're ready to start buying. Now, to buy a stock, you'll need to place an order. This is essentially instructing your broker to buy a certain number of shares at a specific price. You can choose to place a market order, which buys the stock at the current market price, or a limit order, which only buys the stock if it reaches a certain price you've set. And that's it. Remember, always do your research before investing, and never invest money you can't afford to lose. With a brokerage account, buying and selling stocks is just a few clicks away. But remember, with great potential returns comes great risk. The stock market is not a game of chance, but a realm of calculated risks. You could lose your investment, especially if you dive in without understanding the dynamics. However, it's also a platform with the potential for substantial long-term growth. Despite the turbulence, the market has consistently risen over time, creating wealth for patient investors. While the stock market can be volatile, it has historically provided substantial long-term returns. There's more than one way to invest in stocks. Just as a master chef uses different techniques to create culinary masterpieces, investors use various strategies to grow their wealth. Let's start with long-term investing. This strategy involves buying and holding stocks for several years, even decades. It's like planting a seed and patiently waiting for it to grow into a strong, fruitful tree. Long-term investing can yield significant returns, but it requires patience and resilience. Next, we have day trading. This is the fast-paced world of buying and selling stocks within a single trading day. It's more like a high-stakes poker game, offering the potential for quick profits, but also carrying a high risk. Finally, we have value investing. This strategy involves hunting for stocks that are undervalued by the market. It's like scouring a flea market for hidden treasures. It requires thorough research but can offer substantial rewards if you spot the right opportunity. Your investment strategy should align with your financial goals and risk tolerance. Information is power, especially when it comes to investing. One cannot stress enough the importance of researching companies before buying their stocks. Understanding a company's fundamentals like earnings, growth, and financial health is crucial. But so is technical analysis, which involves studying market trends and patterns. It's like reading the company's biography and predicting its future based on past behavior. This dual approach gives you a balanced perspective, helping you make informed decisions. Before you invest, do your homework. Lastly, let's talk about the importance of diversification. Just as we would not put all our eggs in one basket, we shouldn't place all our money in a single investment. Diversification, spreading your investments across various sectors and asset classes, is key to mitigating risk. It's like having a safety net. If one investment performs poorly, others may perform well, balancing the overall performance. Remember, investing in the stock market has its risks and rewards. A well-researched and diversified portfolio can help you reach your financial goals. So go ahead, start your investment journey and stay informed.